So, you've got a world-changing idea. You see all those headlines about startups raising millions, even billions of dollars, and you're thinking, how do I get a piece of that? Well, today, we're going to pull back the curtain on how startup fundraising actually works, from that very first dollar all the way to potential IPO. Let's get into it. But hold on. Before we get into the nuts and bolts, we have to start with a really important question. Is venture capital even the right path for your business? The answer, you might be surprised to hear, isn't always yes. And you know what? Getting this wrong is probably the biggest and most common mistake a founder can make. So here's what we're going to cover. First, we'll talk about a huge choice every founder has to make right at the beginning. Then we'll map out the different stages of funding. After that, we'll get into some of the financial stuff that can be kind of confusing, like dilution. And finally, we'll talk about the one thing that can sink a startup faster than anything else, the funding gap. All right, let's start with that big foundational decision. Seriously, before you even think about a pitch deck, you need to be brutally honest with yourself about what kind of company you're actually trying to build. This one choice changes everything. Think of it like this. You have to choose which basket you're in. In one basket, you've got the explosive growth companies. These are the rocket ships. The goal here isn't just to be profitable. It's to get so massive that you either get bought by a giant company or you go public with an IPO. This is the world of venture capitalists, or VCs. They're betting that you'll be one of the very few companies that gives them a 300x return, because frankly, most of their other bets will go to zero. Now, in the other basket, you've got what we'll call a normal business. The goal here is long-term profit and the founder stays in control. Think of a successful local restaurant or design agency. Both are fantastic businesses, but only the rocket ships are built for VC funding. For the rest of this explainer, we're only talking about that first basket. Okay, so you've decided you're building a rocket ship. Awesome! But here's the thing. You don't get all the fuel you need in one go. You have to earn it, one stage at a time, by proving you can actually handle the climb. And this is what that climb looks like. It's called the funding ladder. First up is the pre-seed stage. At this point, investors are basically just betting on you and your team. Do they believe you can build this thing? Then, once you've launched, you're at the seed round. Now it's all about proving that other people, actual customers, want what you built. Next is Series A, and this is where it gets real. You need to show that you're not just a product, you're a real business, usually with over $1 million in annual sales. And from Series B on up, it's all about pure, unadulterated scale. Investors want to see a clear path to you completely taking over the market. Now, as you're climbing this ladder and taking on all this money, something really important is happening to your ownership in the company. We need to break this down because it's something that hits every founder, not just in their bank account, but emotionally too. So, an investor says they want to give you $1 million. Okay, what happens next? How do they actually get their shares? Do you, sell them some of yours? What's the deal? Let's bust a huge myth right now. In the early stages, that investment money does not go into your personal bank account. It goes straight into the company's bank account to be used for hiring, marketing, growing the business. You aren't selling your personal stock. So if that's true, how does the investor get their piece of the pie? The answer is a little thing called dilution. What happens is the company literally creates brand new shares out of thin air just for the investor. This means the total number of shares goes up. So even though you still own the exact same number of shares you did before, your percentage of the whole company gets smaller. It's a smaller slice of what is hopefully becoming a much, much bigger pie. I know this can sound a little abstract, so let's make it real. We're going to use a super famous example to show you how this works. Facebook's very first big investment. So way back in 2004, this guy, Peter Thiel, who'd co-founded PayPal, saw something special in what was then called the Facebook. He decided to write a check for $500,000. I mean, think about it. That is a huge amount of money to give to a 19-year-old running a website from his dorm room. And for that $500,000, Thiel got a 10% stake in the company. He wasn't just buying a piece of a company. He was making a massive bet that this little college network could one day become a global phenomenon. Now check this out. Here's where the magic happens. If $500,000 is worth 10% of the company, well then basic math tells us that 100% of the company must be worth $5 million. This is called the post-money valuation. It's what the company is worth right after that investment lands in the bank. And just like that, a dorm room project had a multi-million-dollar price tag. And that brings us to the big trade-off. See, every single time you take investment, you give up another piece of your company. It's not uncommon for founders to own less than half their company by the time they get to Series B. And watching your ownership percentage shrink can be really tough. It forces you to answer this one fundamental question. Do you want to own 100% of a $1 million company, or are you cool with owning 20% of a potential $500 million business? There's no right answer here, but it's a choice every single founder on this path has to make. Okay, this brings us to our last and honestly our most important section. You've picked the rocket ship path, you're climbing the funding ladder, but there's this dangerous gap ahead that so many startups fall into. And for most, it's a fatal fall. Let's talk about something called runway. This is maybe the most critical number a founder obsesses over. Simply put, it's how many months your company has left before the bank account hits zero. It's not just some metric, it's your lifeline, it's your countdown clock. And this is what that countdown looks like. Right after you raise a round of funding, you're at 100% cash. But every single month as you pay salaries and run ads, that cash supply burns down. Your entire job is to use that money to hit the milestones you need to unlock the next round of funding before that bar hits zero. If you don't make it, you're stuck. You're in the danger zone. So here is the key to the whole game. Every funding round is just a bridge to the next one. The money you raise isn't just to keep the lights on. It's to buy you enough time to hit the very specific goals, like a certain revenue target or number of users, that will convince the next group of investors to build the next bridge for you. And really, that's the startup funding game in a nutshell. It's this high-stakes, high-pressure climb from one milestone to the next, fueled by other people's money and, hopefully, guided by a brilliant strategy. We've just given you the map. We've talked about choosing your path, climbing the ladder, the price of growth, and how to mind that dangerous gap. The only question left is your strategy strong enough to make it to the top?